Artificial intelligence is creating trillion-dollar companies. Investors everywhere want a piece of it. But before you invest in another AI company, ask yourself one question. How much AI do you already own?
AI is certainly very early for the technological cycle. But of course, when most of the investors are just focused on the same investment story, on the same technology story, and positioned in the same name, the trade does become very, very crowded, which means that even though it might be a very compelling technology story, it may not be as compelling an investment story.
AI may still be in its early days, but the stock market, that's already priced in a lot of optimism. So if investors are paying for the future, why is there talk of bubbles?
It's always very easy to identify a bubble on hindsight. It's very difficult. You can only prove it's a bubble once the bubble has bursted, right? Just using Nvidia as a perfect example, right? Every time they announce their quarterly earnings, they've beat expectations, which means that a lot of the investors are still underestimating the demand of AI. The general S&P is 2021. Nvidia, the stock itself, at its high was 35, but Nvidia is able to deliver earnings growth much higher than the broader US companies, for example. So in that perspective, we won't conclude that the AI or even Nvidia as a particular stock is a bubble. We can, it is more comfortable to say that AI is expensive, but they are justifying it with earnings valuations.
If investors are paying for tomorrow, when does optimism become too expensive?
The current market excitement more so may not accurately reflect the underlying fundamentals. History has actually taught us that technology does not always translate to valuations and profits at the very start. Take for example railways. It basically transformed the ecosystem, but yet many railway companies at the onset of the technology lost money because of the very high level of investments that is needed to actually build them in the first place. And the eventual valuation actually did fall apart simply because true realistic assumptions start to come in. And the bottom line starts to squeeze in terms of valuation versus profits. So is this going to be the same for AI? No one knows.
But here's the part many investors overlook. Even if you think you're sitting out the AI boom, you may already be invested in it.
So an investor could start off saying, let me build a core portfolio of all country world index. So I can buy an index tracking the all country world index, and then I'm gonna diversify it slightly with some bonds and some cash. Now, if an investor is starting with this portfolio, the investors should be aware of the AI exposure, even in such a broad-based portfolio.
Whether you buy AI stocks directly or simply own a global index fund, there's a good chance AI is already one of your biggest investments.
Some investors maybe wants to blend all country world index with emerging markets, thinking that emerging markets is a diversification. However, today, emerging markets are made up of 50% Taiwan and South Korea. Two stocks, largely two of them, the TSMC and the SK Hynix. And is emerging markets really offering the diversification benefits away from AI, or is it actually adding into AI exposure?
Which means buying another AI stock may not be increasing diversification. It could simply mean doubling down on the same investment story. So before buying more AI, first understand how much AI you already own. Then decide whether adding more fits your portfolio and your appetite for risk.
If they are looking to diversify, if you do want to stay, say, within the US stock market, I think there's a lot of other options for investors, such as the Dow index, for example, which is more heavily skewed towards, say, the industrial stories. Investors could also consider looking at some of the value ETFs, for example, or dividend ETFs. But I think also interesting for investors to look beyond US and beyond tech, and our home market, for example, Singapore, has been a huge stabilizer stabilizer for portfolios. Some markets like India, for example, have been seen as a laggard in the AI story, and that's why they've also served well as diversifiers to AI-oriented portfolios.
The first phase of the AI boom rewarded the companies building it. The next phase may reward investors who understand not just what they're buying, but what they already own.